Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined by Connor Campbell. We have already today looked at the FTSE and cable, but now we're going to drill down and look at some specific stocks, three stocks to talk about today, starting off with Barratt Developments. Numbers due out this week?
Yep. Figures on Wednesday. I think it's the first quarter figures on Wednesday. So as you can see, it's been a pretty good year for Barratt. They're up 33%. That £7 mark towards the end of October, that was an all-time high. It's broadly moved higher since the start of the year, but it really got going at the start of October, I think. That was when the government announced they were extending the Help to Buy scheme. You can see that it sort of jumped higher at the start of October, kept going, hit that £7 mark. However, towards the end of October, you can see that giant gap downwards, and that was because Barratt announced it was withdrawing from a development deal with Enfield Council that was worth £6 billion. I think Enfield Council had decided that Barratt's terms were unacceptable, so that meant that Barratt themselves withdrew. Obviously, that severely undermined that £7 all-time high. Also, I think, it climbed so sharply across most of October that it was
still up 33% on the year.
It was just a bit of a pullback, and perhaps the reaction to that news was a bit overdone. Since then, continued to fall higher. Last week you had updates from the likes of Persimmon and Redrow. They didn't go down particularly well. That seems to have weighed on the stock a bit more as well. In terms of its figures, I think it was its full year figures back in September, they were very strong. I think pre-tax profit was up 12% to 765 million. Revenue was up nearly 10% to 4.65 billion. Average selling price was up 6% to 275,000. Total completions were only up, I think, 0.4%, which is not great, but I think it still might be like a record number of completions for the company. In terms of what it does on Wednesday, I think the reaction is very going to be dependent on sort of what is now its next financial year looking like, and how has it coped with we've seen in the last few months wage growth falling, real wages falling, increased inflation. There's been signs that perhaps
interest rate hike
exactly the housing market is slowing down a bit. I think investors will be interested in how has it coped with that over the first 3 months of its financial year. How has it been doing? I think our clients have been buying around that 610, 620 mark. It's fallen quite sharply, since the end of October, the first half of November. There is room for it to bounce higher if you can put out a fairly strong update, as it has done for most of the year, really. If you look at those full year figures, they're sort of very strong any way you cut them. So I do think it's going to be on just how positive it can say. It doesn't even need to sound that positive, I think, to allay people's fears around the sector. So like I say, our clients buying around the 610, 620 mark.
And we'll see with the budget next week if there's anything given back with regards to stamp duties. Look out for that. Right, moving on to, the first of two Christmas-related potentially stocks. Game Digital, well, that doesn't look like a chart for the faint-hearted.
Yeah, it's been, it's down nearly 33% this year. A lot of the action has been around the last few months, since sort of the middle of the year. It was gradually falling lower in the first half of the year. And then, as you can see, it's gone a bit mental, really, in the last few months. Back in March, just to give a flavour, its half-year pre-tax profit was down like nearly 27%. So that gives you an idea of what to expect with Game. As you see, that giant drop in June, that was a profit warning. I think it said that the supply of the Nintendo Switch, demand was very high, but they didn't have enough stock, so it doesn't really matter how much more demand you've got.
Exactly.
And they'd struggled. There'd been a slowdown in sales of PlayStation and Xbox consoles, mainly related to a weaker lineup of games. It just wasn't enough to drive people to buy those consoles. So that led to a profit warning. Things weren't looking very good in June. However, start of July, Mike Ashley buys a 25% stake in the company. As you can see, there's
very good trade. Well done, Mr. Ashley.
The classic sort of vulture move from him. As you can see, that bounced in July. Then towards the end of August, another update. It said, I think it's in the second half of the year, UK sales had jumped 9%. They were still down 7% overall, but still that shows a vast improvement in the second half of the year. And in Spain, they jumped 26%. And this was mainly due to the Nintendo Switch. That's been a huge seller this year. Obviously, they've got some more stock in. It's done very well.
And you look at the Nintendo share prices.
Exactly. It's been Nintendo sort of has one good one bad one. It's sort of on and off with their consoles, but they've really struck gold with the Nintendo Switch at the moment. It's different enough to the PlayStation and the Xbox that whilst you may only own one or the other of the Xbox and PlayStation, if you're into games, there's every reason to own one of those main consoles and a Nintendo Switch. So you can understand why it's been, it's name recognition as well, the new Mario game. Heading into Christmas, I think that's really going to be the focus for Game, because that should be, if they can get enough stock, a massive seller. That actually helped them eke out a 0.1% rise in annual sales, which sounds like nothing. But for a company that feasibly could have been wiped out by Amazon by now, and look, it hit below 20p per share in July. It almost was. Eking out any annual growth in any annual sales growth is pretty impressive. In terms of this week, it's its full year figures. They did say in June, that pre-tax profit or profit, would be substantially lower than expectations. How substantially lower, I think, is going to be the key on Wednesday. If they can post a good outlook for Christmas, say that we are forecasting X amount of sales based on the Nintendo Switch, then maybe that can soften the blow of that profit decline. But again, it really depends on how much it's fallen. Also, interestingly, in August they said they're going to start to switch more of their focus onto esports. And I think at the moment, despite its pretty ropey stock price, it's like the highest valued tradable company in the UK in the esports arena. It's a really fertile ground for them to go into. I think they've already got a few, things in a few pies that suggest that they're in a position to more fully move into that area. I think the worth of that sort of sector as well is approaching 1 billion. I imagine it's only going to grow in the next few years. It's sort of gradually a big deal. You see more and more bigger competitions, higher monetary prizes and stuff like that. So I think it's a pretty savvy move for Game Digital to try and diversify a bit away from a sector that could be eaten into by Amazon, and obviously has been eaten into by Amazon, into something that maybe they can get ahead of their competition. In terms of our clients, I was surprised to see how many of the clients are buying around that 40p mark. I think perhaps the Nintendo Switch will mean that Game has a pretty good Christmas. So if you look at the other side of Christmas into January, perhaps it's January update, then you could see some pretty healthy figures from then. But like I said, in terms of this week, the reaction is really going to be dependent on the size of its pre-tax profit loss.
And finally, looking at Royal Mail, you mentioned Christmas. Clients, bought this stock on the IPO. Are they kind of licking their wounds? It's been a bit of a dog, let's be honest.
Yeah, I think it just has the stench of failure around it, basically, because it's by its nature, it's sort of an archaic, outdated company. Just through no fault of its own, I don't know what it does to turn it around, because in and of itself, the services it's provide are almost obsolete, basically. If you look at its figures, they're not really that bad. I think revenue was up 1% to £9.8 billion. That's no small chunk of change. And pre-tax profit was up 25% to £335 million. That was mainly due to its sort of international arm, GLS. That's really, really strong. I think in terms of the figures that tend to draw focus whenever Royal Mail releases, letters revenues were down 5% on 6% drop in volume, which I don't know what Royal Mail does about that. Parcel revenues were up 3%. I think that's gradually becoming. I think in a few years that will be the bigger half of the company. I think at the moment it's approaching half the the value of revenue. Once that tips over into say even 51%, or and continues to increase, then perhaps Royal Mail can see things a bit of a turnaround. They might have to settle for a slightly lower stock price, and they may have to settle for slightly lower returns, but there is room, with parcel deliveries. Amazon obviously is, again, as we're talking with Game, the major player in sort of parcel deliveries, but not everything is bought through Amazon, and that does, the rise of online shopping does give Royal Mail a foot in the door there, as we've seen with, the parcel revenue growth is pretty consistent. In July, it said that the letters revenue decline had slowed down a bit, that it was only down 4%. But that was mainly due to sort of political mailings around the election, so I'm not really sure if that's a sign of a turnaround or just a brief moment of respite for the company. It hit all-time lows in October. That was mainly due to an update from Credit Suisse that was incredibly negative around the stock. I think they cut its target price from $4.92 to $3.25, which is a pretty sizable cut, and said that a worsening decline in letters revenues and rising labour costs. Obviously, you've got all the pensions issue around Royal Mail and the constant threat of a nationwide strike looming over it heading into Christmas. That sort of undermines its ability to sustain its earnings. So again, not a lot of good news coming out. I think in terms of its half-year figures this week, I think operating profit is expected to be down 15% to 270 million. That sort of splits into a 26% decline on the UK side of things, but a 21% rise on the international GLS side of things. So again, there are positives to pluck out amongst all the negatives.
Numbers due on
Thursday. Numbers due on Thursday. Clients buying around the 370 mark, I think largely due to just how low it's fallen, basically. There is room for it to rise if the figures are slightly better than expected, if it can give a positive update about its outlook for Christmas. Obviously, those Christmas figures are more pertinent, the other side of the festive period in January. But if it can sound positive going into Christmas, then that may help rescue what has been a pretty dogged performance this year.
Well, on that note, we're going to have to wrap it up. No pun intended. Connor Campbell, financial analyst at SpreadX. Thank you for joining us here
Thanks
today.
very much.